year is concerned, all right, what I want to do is kind of reflect back on how last year went, and then we'll use that as a platform to understand what to expect from the US dollar, from gold, from risk assets across the board, emerging markets, and all the other currencies across the board for the year 2026. It's all about understanding the direction of travel for the Fed, and that's determined by the economic data. We're going to be talking about last year's inflation. I'm also going to cover the jobs data from last year and how that has affected the significant cuts, or rather the subsequent interest rate cuts that we've since then seen. All right. So yeah, before I get going, let me check the chat. Guys, if you want to text me, hit me up in the Q&A section, and that's when I'll be able to read you. We've got Brian signing in from Kenya, Kamukhelu from South Africa. Eric says chat is disabled. All right, hit me up in the Q&A, guys. Hit me up in the Q&A. Kenya is in the building, guys. It's Piwe from Mzansi. Shout out. All right, Desmond watching from Nigeria. Hermanus. I hope I didn't butcher your name, bro. If I did, forgive me. It's still like the fifth day of the year. All right. I'm still stuffed with Christmas lunch. Okay. So yeah, I think I'm gonna need to go on a bit of a diet. I think I gained about 15 kilograms between the 24th of December and the 26th, ladies and gentlemen. So let's see. What are we cooking today? Let's talk DXY, all right? Straight out the gate, guys. You can see I've got the DXY, and this is the dollar index on the screen. This measures the relative strength of the US dollar relative to the other currencies that it is trading against, particularly the euro, the pound, the yen, etc., etc., etc. So I want to start with a bit of a segue. While you guys look at the chart, just listen to the narrative and the picture that I want to paint, all right? Because this is the first full trading week of 2026, and it didn't open with a whisper. All right, it opened with the low hum of expectation. All right, with anticipation, unfinished business from 2025. All right, inflation didn't fully die. CPI went from around, let's check this out, let's peep this closer right now while we're talking about inflation. Let's peep this a bit closer. CPI relative to where we are right now, all right, at the beginning of 2025 was sitting at 2.9%. Right now, as it currently stands, ladies and gentlemen, CPI is sitting at 2.7%. So there has been progress made on inflation. All right, but not to the extent that warrants aggressive interest rate cuts. All right, the labor market also didn't fully break. While we did see a big loss in the jobs data, all right, beginning from around middle of the year, June, July, coming right through all the way to November, December, we did see a little bit of a crack start to emerge in the labor data. We saw NFP data shoot down historically from the mid 150,000s per month all the way down to, I think the lowest figure for the year last year was about 15,000 jobs. In the latter half of the year, correct me somebody if I'm wrong, but in between 10 to 25,000 jobs is the lowest number that we got. And we got those subsequent revisions, the downside revisions of the earlier data from June, July, and August. All right. It was revised down lower. All right. So the labor market didn't fully break, and therefore the Fed didn't fully blink. All right, the Fed didn't fully blink. That's what I meant to say. They gave us those three interest rate cuts, and I think Jerome Powell walked away from 2025 saying, "Boys and girls, hold that. That's what you're getting." All right, January is not a given in as far as getting another rate cut expected, which is the catalyst that we need to weaken the dollar so we can buy gold again, buy Euro USD, buy GBP USD, and buy risk assets. So, guys, that's the backdrop. All right, as we step back onto our trading stations. That's the backdrop as we have our coffee in hand in the morning, eyes scanning screens like a villain in Gotham City from a high-rise penthouse. You feel me? This is not a reset, guys. 2026 is not going to be a complete reset for markets. It's, in my opinion, going to be a continuation of a long strategic chess match. All right, now let's talk inflation while it is on the screen above. It's been 2025 doing what most villains do. I mean, if you compare this to Batman, which is one of my favorite movies, and therefore that's why I've always got this superhero and villain dichotomy. All right. Inflation right now is the villain. You could call it the Joker. All right. The one persistent villain that refuses to go away. All right. It retreated into the shadows, slowed its pace from 2.9% all the way down to the 2.7, 2.6 handle, but it never really truly left. All right. Headline numbers have cooled comparatively. to the chaos that we saw to prior years, all right? Coming out of COVID, I think you can see on the chart that we've got right there from 2021, we peaked at around, let's peep this closer, we peaked at around 9.1% in 2022 in the seventh month. All right, in July 2022, inflation peaked at 9.1%, and that's a result of the Russia-Ukraine war, the oil sanctions, the supply chain disruptions coming out of COVID, as well as all of the demand coming in to the economy right after lockdown, which pressured a whole lot of supply chains. So far, am I making sense, guys? Am I painting the picture in an adequate way? All right, are we getting a sense of how we exited 2025 versus how we're going into 2026? I need to get used to saying 2026. All right, so inflation did recede momentarily in the year 2025, but it has still been sticky. All right, headline numbers have cooled comparatively to post-COVID years, but the Fed's real headache was the persistence from 2.9% to 2.7%, where we are right now. All right, services inflation. All right, so this is everything in the services industry. We're talking doctors, Uber drivers, we're talking anything that is providing a service. That inflation stayed sticky, particularly. When it comes to housing, that remains stubborn. We're still seeing price pressures on housing. Energy as well, which is very volatile, all right? Particularly when there's geopolitical instability. And that's what we're going to talk about later on in the stream. We've got Trump pulling another crazy one, arresting the president of another country, but I'll talk all about that. Now, because of the sticky inflation, the Fed spent most of the year trying to balance out being hawkish with being dovish, all right? Meaning they were stuck between cutting and holding interest rates unchanged because we've got inflation high, and if you drop interest rates, that's gonna increase the level of spending, which then can have a net effect of increasing the overall inflation. So we were stuck there, but I think that the catalyst was the July jobs data, which pointed downwards, and that's what forced the Fed into a corner, and that's when we got our first interest rate cut in September, right after Jackson Hole. All right. So rate cuts were discussed, they were teased, they were priced in by the market, and at times priced out again. That's how 2025 was. The message was clear, guys. Inflation progress really mattered. But so did the jobs numbers. Okay. And so they're caught between a rock and a hard place. We drop the interest rates, it's going to put money back into people's pockets, which then drives up retail sales, which then drives up CPI again, and then we're stuck with sticky inflation. And on top of that, we've got Donald Trump's tariffs. All right. Don't forget that. That's still a thing. All right. Which is making the cost of goods more expensive. Okay. So inflation is still a thing, but the jobs matters. The jobs data matters as well. So by the end of the year, by December, last month, last week, inflation was no longer an emergency, all right, guys. But I don't think that the Fed can really do a victory lap either. That's why I say that this year, the first 4 months of this year, is going to be about unfinished business. We're not pivoting to a new narrative, all right? Now, while we on last year's data, I also want to talk jobs, all right? Because we've got the NFP data lined up for later on this week, all right? Friday is the day. We've got that NFP data, and the expectation right now is sitting around 60,000 jobs from 69,000 jobs, and that'll be weak data. That'll be bad for the US dollar because the more bad news we get, and as far as the US data is concerned, the more aggressive the Fed is going to be with interest rate cuts. All right. And every time the interest rate goes lower for the US dollar, that weakens the dollar because it detracts investors. How can I put this? Let me just gather my thoughts here real quick, guys. Interest rates for investors. I'm going to put this in very simple English. Size matters. Okay? If you don't get it, forget about it. Size matters. Maybe in other areas of life, it might not. But when it comes to interest rates, size matters. Investors want more. Bigger is better when it comes to interest rates. Now, for those of y'all that have your mind in the gutter, get out of there. Okay? Get out of there. That's not what I'm referring to. But when it comes to interest rates, honestly speaking, size matters. So the higher the interest rates, the more attractive your currency is going to be to speculators or investors or traders who want exposure to your currency so that they can benefit from fixed term. That's what I'm looking for. Fixed term, long-term investments. All right. Yeah. Fixed long-term investments. That's the full word I'm looking for. All right. Which will then give them the yield, which is then linked to the bonds. Okay. So that's just me kind of catching you up on the relationship between interest rates and the demand of a particular currency or lack thereof. All right. Chat, am I making sense? Did that make sense? Just let me know. We're sitting at 41 strong in the stream. I'm happy about that. That's lovely. That's lovely. That's lovely. That's lovely. Chat, hit me up in the Q&A. What do you guys think about the way I just articulated that? Did that land very well? All right. Mr. Etim says, yeah, you're making sense. Shout out. All right. Now, the jobs numbers, as you can see, guys, we are expecting a lower jobs number. Now, should we get this lower jobs number, ladies and gentlemen, this is the catalyst that happens. Now, we're looking at the DXY. All right. And straight out of the gate, you can already see we've been in this bullish sort of scenario, creating higher highs and higher lows. And that's why I've marked out this trend line. All right. We had the higher highs, higher lows, and this trend line held over here. And what we saw was a resurgence of the dollar until we got that interest rate cut in September. And I think you can see that because it probably culminates with, okay, well, it's further down to the left, but we peaked out here, created a double top. That's a classic M formation. Beautiful. Classic M formation. All right. Beautiful double top. We broke through the trend line. And since then, ladies and gentlemen, we've been creating lower lows and lower highs. All right. And we've also been creating bearish reversal patterns, such as this classic descending channel. And now we're stuck in the middle of a bearish bear flag, what looks like a potential bearish bear flag. And what we're seeing is that since creating this lower low, the market has rallied up and tapped this zone of interest 3 times. All right. And I think that this is the area of interest for speculators of the dollar. This is where the dollar is either going to hold the line and continue to weaken downwards. But this scenario is the scenario that's in line with weaker jobs data. So should we get the payrolls data on Friday coming in as per the estimates, we will see the US dollar weaken to the point that I have just articulated there. We've seen this support that's sitting around the 96 handle, and we're seeing the resistance sitting around the 100.5 handle. So this is the weaker economic data situation. Should we get a resilient jobs number, then I think we could be looking at a rotation back up to the upside to come and retest these recent lower highs over here, that area of interest. There's still a lot of liquidity located way up there. All right. But there's still a ways to go before we can really seal the deal and call it a wrap for the US dollar or have a narrative that the US dollar is coming back. All right. Now, let's quickly move on with our narrative. I'll still painting the picture for you in and amongst checking the jobs data. We're still talking about the jobs data. So for the market, the jobs data, ladies and gentlemen, is could be the the major catalyst that determines whether we see gold giving us new highs again, or whether we see a resurgence of the US dollar. That will mean that assets like gold will pull back. If we get a positive jobs data, anything above 60,000, maybe teetering just below 100K, 80K, 90K. If we get a 100K handle, anything in that range, 80 to 120, basically, let me just make it simple. Anything from 80 to 120 on the jobs data, we will see a US dollar on the front foot because that will take off the prospect of getting an interest rate cut in January thoroughly off the table. As it stands, as I speak to you, ladies and gentlemen, let's check out the Fed Watch tool, all right? Because this is what guides the probabilities of whether we get a cut or not, all right? If we take a quick peep at the Fed Watch tool, the probability of getting another interest rate cut in 23 days, am I lying? No. 23 days, 3 hours, 39 minutes, 30 seconds, as from the time that I'm speaking to you right now. The probability of getting a cut is sitting at a measly 16%. All right. So a lot still needs to happen in order for us to basically reach new highs on gold, for Bitcoin to come back into the conversation again and rotate from this pullback that we are seeing. For the other currencies, the majors, such as the euro, the yen, the pound, for them to rotate back up again and create new highs on the 4 hour time frame, we need to see the 16% come closer towards 50%, 60%, 70%. The more we see an increase in this chart or this probability, the higher we will see risk assets rally. NASDAQ, Dow Jones, gold, GBP USD, Euro USD, gold. I said gold twice. Maybe that's how much I like it. But yeah, we will see assets such as that appreciate against the dollar should we see the probability of an interest rate cut continue to be priced in. But that is dependent on the economic calendar. There's a reason why I'm always bouncing in between all of these tabs. All right. There's a relationship between all these things. All right. Today, we had ISM manufacturing PMI data. So the more bad news we get across this week, every single piece of bad news is going to be good news for all the other assets. I think that's as easy an equation as I can make this for you, ladies and gentlemen. The more bad news. So tomorrow, I'm not tomorrow, tomorrow's Tuesday, Wednesday, we've got the private payrolls and ISM services PMI data as well as jobs job openings. Should we see bad news in all three of these categories, then we will see a rally on euro, pound, yen. All right. We will see the rand strengthen against the US dollar. We will see gold maybe try to recapture those new highs again and give us another higher high. That is a possibility. But I believe that a lot of the big money is going to stay out of the game up until Thursday, Friday. All right. For the first full week of 2026, I think the first real trading day is going to be Thursday or Friday. All right. Yes, the days leading up to Friday can be a catalyst and give us an insight on what to expect, particularly if we get bad ADP data, all right? Or if we get great ADP data, if we get great private payrolls, that says something about the public payrolls that we may get, all right? I mean, the non-farm payrolls that we may get, all right? So we can use some of this data on Wednesday as a leading indicator into what we can expect or price into our thinking for Friday. Jobs job openings, same thing there. Thursday, the big one as well. We've got the reason why I say the first trading day is Thursday is because we've got initial jobless claims. Okay. We've got December claims from the week of the 27th, and we've got last week's claims from the 3rd of January. And we can see that if we get higher data for initial jobless claims, so if we get something like the expectation right now is 216 or 216,000 people filing for unemployment insurance benefits for the first time last year. If we get a higher figure, something into the 250s, that is bad news for the US economy, and that is a bullish scenario for risk assets as well as gold. All right. So this is why I say that the scenarios that we're going to see Wednesday, Thursday, that's going to lead us perfectly into Friday, where we're looking at first and foremost, the unemployment rate, because it is sitting at 4.6% right now. If we still continue to move up from there and maybe go to a 4.7%, then I believe that that fully prices in a rate cut for January. The Fed has no choice. They will give us another 25 basis points interest rate cut. That makes gold on the front foot. That puts the euro on the front foot. GBP on the front foot, Bitcoin on the front foot. Ladies and gentlemen, I don't need to sit here and analyze all these charts and pull them all up. I'm trying to make this so easy for you guys. The technical analysis is up to you. All right. You can determine the timing of how you'd like to interact with whatever financial asset you will be trading when it comes to NFP. But I'm making it so simple for you. Bad news on the day is going to be bad news for the dollar. If the dollar weakens, it's a buy against the dollar. If the dollar strengthens, and the base case for that is good news, all right. So if we get low initial jobless claims, that's going to be dollar positive. We might see a slight pullback in gold. We might see a slight pullback in GBP USD. We could see a slight pullback, or no, not a slight pullback, but a rally in USD CAD or a rally in USD ZAR, because that will put the dollar on the front foot. Ladies and gentlemen, I think that should make sense. Now, what I want to do is also wrap this up by also talking about um, what we should be watching. All right, going into the week. Gold, ladies and gentlemen, it's going to be a very interesting week for gold. All right. Um, Against the backdrop of the US dollar entering into 2026 sort of kind of not weakening, but not on the front foot either. We are seeing high relative rates right now in the US, comparatively speaking, to where we were pre-COVID times. All right. The dollar still does remain king, but kings are watched closely, and particularly when the crowd gets nervous. All right. And right now, the crowd is getting nervous. We're seeing geopolitical instability rising. All right. Donald Trump just literally kidnapped the president, the sitting president of Venezuela. Guys, we're living in a movie. We're living in a literal movie. What do you guys think about that? Hit me up in the chat, guys. Chat, do you guys think he took the president of Venezuela as alleged by him because of cocaine? What are we doing here? Do we think he's going to literally risk the threat of instability in South America because of cocaine? Come on, this is not new news. This is not brand new news. We had Pablo Escobar. We had what's his name again? I'll tell you just now. We had the guy from Mexico, the short one. What's his name? Oh man, there's a Netflix documentary on him as well. El Chapo Guzman. We had El Chapo. We had all of these drug lords, guys, peddling cocaine in and out of North America and South America. They never took the sitting president of the country. I don't think I'm calling cap on cocaine. I'm just saying, I'm calling cap on cocaine. I'm saying this is all about oil. All right. This is all about oil and private big business. That's what this is all about. Spear says, let's not get into conspiracies, bro. Listen, man, I live in conspiracy theories, bro. I'm about to take off the Just Markets hat and put on the tinfoil one. All right. Man, all I'm going to say is it's only a conspiracy theory until we say it's correct. And there's a lot of things we've been correct about. All right. Nobody thought we'd all be locked up in our houses, not allowed to move freely, forced to take medication because of an illness that's global. All right. Nobody thought that would be real, but it happened. Okay. So, yeah, all I'm saying is I really think that what's happening in Venezuela right now, let me be serious. What's happening in Venezuela right now has the capacity to spill over into a regional conflict in South America. And Venezuela, for your information, guys, is a big producer of oil. All right. They've got a thicker type of oil in Venezuela that is used by American petroleum manufacturers or refiners rather, and they mix it with a lighter oil to make the fuel that we now have as a finished product. So the president of Venezuela, Mr. Maduro, was in favor of nationalizing that asset and really being hard on American companies, and as far as Chevron is concerned, and as far as Anglo is concerned, and as far as them extracting that resource from their country, they wanted to take a different route. He was taking a hard stance against America. And in the dead of night at 2 o'clock in the morning, the DEA swept in on him and his wife, took him on a plane, flew him to America, and today, as I speak to you, he's in Manhattan awaiting to see a judge at the courtroom. So make of that what you will. In as far as the oil market is concerned, we're not seeing any big moves there yet. Okay. I think this only starts to be a crisis once we start to see the price of oil move up. But as it stands right now, even the US dollar index is not really getting a big lift from the safe haven properties that you would expect to come from geopolitical instability like this. However, gold did gap up this morning. That's one thing I did notice. And that's how I'm going to close off today's stream, guys. We're about 29 minutes in. Here's where gold is sitting, ladies and gentlemen. We've got our recent low or support around the 3,900 level, and the new high is around the 4,550 handle. All right. If I move into today's price action, we are seeing this up move. These green bars are from today's price action. All right, and that's a result of the safe haven demand that's coming from the geopolitical instability as a result of the sitting president of another country basically being kidnapped in the dead of night with his wife. All right, and on top of that, Trump came out with a strong man press conference. Now, don't get me wrong, ladies and gentlemen, I am a big fan of Donald Trump. All right, I am make America great again because I believe when America is great, the whole world will thrive. Okay. I don't really agree with what's happening right now. Kidnapping the sitting president of another country is a dangerous precedent, for lack of a better word, and a slippery slope. We've got this being condemned worldwide by other leaders. And in the wake of that, you think that Donald Trump might be like, you know what? Yo, chill out, guys, chill out. He's like, no, 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 no. We're actually going to run Venezuela up until further notice. And what we're going to do, I'm actually looking at you, Colombia, now. I'm actually looking at you, Mexico, now. So we're seeing this strong man posture being thrown around right now, and it is pretty shaky. I feel like right now it's still early days. This will happen over the weekend. We've got to give it maybe 2, 3 days to progress, see if there's any retaliation, see what world leaders say, see if there's any shakeup in the markets. Is there any reaction from oil? Does this affect the supply or the demand? That remains to be seen. And again, I close off the stream by saying, ladies and gentlemen, it's a waiting game. All right. Trading is 80% waiting, 20% action. We wait most of the time. All right. So I think we've got to wait for a few days to see how this permeates across the risk spectrum. But as it stands, ladies and gentlemen, we've got a lot of catalysts. I've discussed them this week. The major one is the jobs data. And if we see a positive jobs number, we're definitely in the realm where we could start talking about a move that breaks above the new high and gives us a record high again on gold. But if we get bad news, we could see a retest back up to the level and come back first target to interact with this level right over here. All right. We've got this trend line already, and we can see some bullish demand. We can see some support at these lower levels, and that this can still happen. All right. This can still happen. We need to watch the data. We need to watch the price action because this can also happen. All right. But this scenario only happens if we get brilliant US economic data, ladies and gentlemen. All right. And right now, I don't know on the balance of probability if we can really say that. We also need to factor in the fact that we've got seasonal jobs from the festive season. So if we do see a little bit of a bump in the jobs data, if we see lower initial jobless claims, it could be because of the festive season jobs. But remember, those are temporary, and we will see the jobs data moderate again around February, March. All right, because of the foot traffic that's now left the stores or leaving the stores, we're going to see a cutback on the temporary employees. So we might see that figure show up in the employment data. But alas, the equation is simple, ladies and gentlemen. I'm going to leave you with this. Good news this week is going to be good news for risk assets, gold, crypto, Dow Jones. Listen, equities, everything. All right. Bad news. No, 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 no. I'm lying. I'm lying. I inverted that equation. I'm confusing you now. Bad news, guys. So if we get lower NFP, higher initial jobless claims, lower ADP employment data, that's going to be bearish for the dollar. It's a big fat buy for risk assets, gold, equities across the board, according to economists on Bloomberg and according to my own analysis as well. Remember, that's not a signal, that's just speculation, all right? That's an action reaction function. That's me pricing out the probability, pricing in rather the probability of getting another interest rate cut. I'm not just sucking this out of my mouth. I am literally looking at the data, looking at who looks at the data, looking at what the implications of the data might be when they make a decision. So good data holds off the interest rate cut for January. They might just leave it at where it is, and that's what puts the dollar on the front foot. That's the equation that sells gold and the other risk assets. But bad economic data, I mean, good economic data, ladies and gentlemen, that is what puts the US dollar on the front foot, gold and risk assets selling. But bad economic data is the bullish case scenario for risk assets as well as gold, equities, crypto across the board. Any questions before I put the stream to an end? Because, ladies and gentlemen, we've just come to the end of Just Markets Live for today. We ran exactly for 34 minutes at the peak. I saw, I think, 50 people in the chat. We've got Kenya in the chat. We've got Nigeria in the chat. We've got South Africa in the chat. We've got conspiracy theories in the chat every day. All right. That was a beautiful stream, ladies and gentlemen. Um, Anonymous attendee says World War III in the making. Potentially, potentially, bro. But if that happens, gold to the moon. If that happens, gold to the moon. All right, ladies and gentlemen, any questions before I end the stream? What I do want to say, announcements, guys. Please do check your Just Markets app, check your emails, because that's how I'll be communicating with you to let you know when I'm streaming, all right? Up until such time as we have a whole lot of people and a whole lot of demand for the stream. The peak I think we've done is about 80 odd people, all right, in the stream. So the more we can get these numbers up, the more I will be streaming. I shouldn't just be streaming on a Monday. Ideally, it should be about 3 times a week, Monday, Wednesday, and maybe like a Thursday session. I don't know about Fridays, but that's when NFP is going to be. So I might live stream the NFP data, do a live watch along, do some analysis, commentary. So yeah, if you guys create the demand, I will supply. Okay. I think we can end with that beautiful metaphor. That landed exceptionally. Damn, how'd I come up with that? All right.